Hello everyone, and welcome back to Dr. Tao's Quant Lab. Through the first 7 sections of this course, we have built a rigorous mathematical foundation. You know how to neutralize your psychological biases, and more importantly, you know how to build the valuation matrix. You know exactly what a stock is worth. But knowing a stock is fundamentally undervalued does not mean you should blindly press the buy button. Valuation is a map. Execution is driving the car. Today, we transition from pure analysis to strict execution. We are going to cover the two distinct schools of market entry. Starting today with the most contrarian method in investing, left side trading. Imagine a stock chart showing a major price correction. It forms a V or U shape. The left side of that shape represents the price actively falling. The right side represents the recovery. Left side trading is the practice of entering the market during an active decline. In the media, they call this catching a falling knife. Mathematically, you are buying while the short-term rate of change of the price curve is negative. You are stepping right in front of active selling pressure, betting that the fundamental gravity of the stock is stronger than the market current panic. Because you are fighting the trend, left side trading carries immense risk if applied to the wrong assets. So, what stocks are actually suitable for this strategy? You must strictly reserve left side trading for most resilient assets in the market. We are looking for high quality, industry leading giants with medium to large market capitalizations. Specifically, we want companies with highly stable profitability that have fallen sharply due to a macroeconomic correction or sheer market panic, pushing their PE ratio deep into or range 1 deep value floor. On the flip side, let us establish the Aaron rule of what to avoid. You must never attempt left side trading on the following 3 cases. First, newly listed IPOs that have been trading for less than a year. Second, penny stocks under $5 or microcaps under 1 billion. And third, companies that have not recorded at least 4 consecutive profitable quarters. Why? Because if a company has no earnings, it has no fundamental floor. When the market turns against an unprofitable speculative stock, there is no mathematical gravity to stop the price from going to zero. Depending on your time horizon, there are 2 ways to trade the left side. Strategy 1 is long-term value accumulation. But you cannot just guess where the bottom is. You must scale in using a strict risk control formula. In the quant lab, we use the 1-2-3 inverse pyramid, or the 1-6, 2-6, 3-6 rule. You divide your allocated capital for this stock into exactly 6 parts, and you execute in 3 strict tranches. First entry, 1/6 of capital. This is your probe. You take a small 16.7% fielder position at the first major support level. If the support breaks immediately, your portfolio barely feels it. So the second entry, 2/6 of capital. You exactly double your first entry, but you only deploy this if the stock drops by a painful, predefined margin, like 15% below your first entry. So the final entry, 3/6 or half of the capital, you exactly triple your first entry. This massive 50% bullet is reserved for absolute generational panic pricing, another 15% drop. Because you reserve the heaviest capital for the deepest discount, your average cost basis is violently dragged down to the floor. As we prove in the textbook notes, I will leave you to read this. A stock would have to crash 60% from your very first entry just to trigger a standard portfolio stop loss. This is how you mathematically survive a market panic. Strategy 2 is for shorter term swing or wave trading. Because you are relying on price memory and techniques rather than deep multi-year fundamentals, the rules change entirely. First, you only attempt a left side swing trade if the broader market, like the S&P 500, is still in an established uptrend. Do not play this game in a macro bear market. Second, demand deep structural support. Ignore a weak 38% Fibonacci retracement. Wait for the extreme 61.8 retracement level. We will cover this in chapter 2. And finally, you must use a strict stop loss. If that structural support breaks, you cut the loss immediately. You do not initiate a riskier operation to average down. Hope is not a quantitative strategy. Left side trading requires patience, extreme discipline, and an iron stomach. In our next video, we will cover the exact opposite approach, right side trading, where we wait for mathematical confirmation before deploying capital. And as a quick reminder, now that you understand the theory of left side trading, I am applying this exact math to live stock right now. Check out the individual stock analysis playlist on my channel page to see where companies like Apple, Meta, and Nvidia are sitting on our valuation matrix today, and whether they are flashing a left side buy signal. Thank you for watching, and I will see you in the next lecture.